The most interesting news, what happened last week, are the NVIDIA earnings. Absolutely blown away. 56% up. The revenue increased by 56%. That's a crazy high number. There are very few companies that can manage to do this. And if you look at the entire AI hype, there are a lot of different companies out there trying to benefit from this. But the big one is NVIDIA. I think the other big one is Microsoft with all their data centers. There's so much data capacity required for all the AI investments that are being made, that they are a big winner as well. But clearly, Nvidia is coming out on top, 56%, amazing. Their data revenue centers or their revenue from data centers grew 5% from first quarter, and also grew year on year 56%. And their Blackwell data center revenue grew by 70% sequentially. Now, these results are nothing to scoff at. What I think about NVIDIA, what I think is scary about NVIDIA, they grow exponentially fast. 56% growth year on year is crazy, but it's not sustainable. The story around NVIDIA is amazing. Everybody's over the moon, everybody sees the potential, and they deliver on the potential currently. That's the story that's being told right now. But the question you should ask yourself, can they continue this story for the next 10 to 20 years? Can they continue a 56% growth year on year? It's very unlikely. It's very unlikely. So if you step in now, they are valued at a 56% growth percentage year on year. Is that something that they can keep up? I think as the whole AI market keeps growing, NVIDIA will profit from that, but 56% is unlikely, just because the math doesn't add up. You can't keep growing 56% year over year over year. And that will mean the market for AI applications will explode. And that's unlikely to happen. So most likely they will grow in absolute numbers quite large, but percentage wise, it won't be 56% year on year. So I'm quite careful with NVIDIA. I don't think it's an investment right now. For me, it's a pass. I think the story is it's too difficult to value where the whole market as a whole will go. But these numbers are insane, and I think they still surprised everybody. Even though the stock dipped, so the market expected even more growth, expecting more than 56% growth year to year, is I think is ridiculous. And I don't think that's a story that can hold out for the long term. But in the short term, it's very interesting to look at. I think next up, we're going to take a look at Alibaba earnings. Full disclosure, I own Alibaba shares. I bought in at around 80 to 120. No, I started buying way earlier, at around 200, and then it dipped, and then I bought more. No, I don't want to join the limited time offer. And they recently jumped. They took quite a jump up, 13%. The stock has been downbeaten over the last few months, I believe, maybe even longer. It was down quite bad. Nobody wanted to invest in it, and that's mostly because of the China story. I think everybody is afraid of China, and rightfully so. China is a little bit of an unknown factor. We don't really know what's going on there. But if you look at the whole of China, I think they are set for growth, and Alibaba therefore is set for growth as well. As the whole economy of China grows, Alibaba is very well positioned to profit from that growth from China as a whole. And now that their AI and data centers are growing, and they showed quite a big growth there, I think around 26% on the top of my head for just that business unit, which is quite a lot. We'll be looking more in depth at Alibaba right now. Now, what are we looking at? We're looking at an overview of Alibaba that's generated by our software. Why do we put this at the top? There's only one reason you would be interested in looking at this stock, and it's, do I want to own it? Yes or no? And you only want to own something because you think it's going to grow in value. So on top, we have some valuation metrics. And then below that, we have some easy to understand metrics to quickly take a look at the stock. You see the name of the stock. You see where they're traded. They're Chinese, but their exchange is over on the New York Stock Exchange. You see which industry and sector they're actively participating in. You see their price, and over here you see some metrics and our due diligence. These top few three metrics, they are driven by our own proprietary algorithm. They are based on value investors and how they look at certain businesses. Now, this is not meaning if these are all checks or red crosses, it doesn't mean go out and buy right now or sell it off and run away as fast as you can. But it gives you an indication of whether something is interesting, yes or no. Financial fortress means, do they have staying power? Do they have the financial capacity? Do they have the liquidity? Low amount of debt? Do they have the right margins? Do they spend too much on their sales and marketing spending? Do they spend too much on R&D spending? If so, they will be crossed off. Compounding engine is mostly looking at their ability to compound their growth, and therefore they need to have multiple growth metrics that kind of feed into each other. So, for example, if they grow their revenue and then they grow their free cash flow even more, and from that free cash flow they can return it at a higher return on capital, and then they can compound on their revenue growth, and that's what you want to see, because then they can grow to exponential value. And entry price is just looking at, is the stock at a good price currently? Are you not paying too much? Now, Alibaba doesn't check any of these, so you would think it's a bad story. But let's take a look in detail. What's actually happening here? If we expand our due diligence, this is being generated by our AI model. It's looking at the last few earnings calls, and it's summarizing all of those. It's looking through the sales page that's given by management, and it looks at the data that's being displayed there, and how management views the future. Are they optimistic or not? And what are they actually doing to grow the business? What's happening there? You don't have to read through all the different earning logs yourself. You can just use this, rely on the summary to see if something is interesting for you, yes or no. Once again, this is not advice. This is not to say, hey, if this is positive, I go out and buy it straight away. No, do your own due diligence. Look at the business. Is this something that is right for you? Does this fit your portfolio? Don't just go out, buy something because somebody on the internet is enthusiastic about the stock. That's the wrong way to look at it. Now, if we take a look at what it says here, Alibaba has a strong edge in e-commerce and cloud services. They are a big e-commerce platform. You can think of Amazon, but then Chinese, and cloud services. You have an AI-driven strategy. It's gaining traction, and it's showing triple-digit growth. This positions them well against competitors. Now, their growth ability, it's on a solid growth plan. They report a 36% increase in adjusted EBITDA for fiscal year 2025. So they talk about their user increase, which is quite massively. They're still growing. They're still growing business. As China as an economy grows as a whole, Alibaba will profit from this. Their future expectations, as reported by management, are very optimistic. They're optimistic about the AI-driven future growth. That's why they heavily invest in their AI strategy as well. They expect to return to double-digit revenue growth in the second half of the fiscal year. If we go back to their earnings report, or as reported by CNBC, they only grew revenue by about 2% year on year, which is it's very marginally. It's not very good. It's not why you would buy them, or not why you would want to own them. But they expect to be back to double-digit revenue growth, so above 10% in the second half of the fiscal year. So there's something to look forward to. Now, this is something that you have to take with a grain of salt, because management say they expect to return to double-digit revenue. You never get a guarantee that it will go back to double-digit revenue. And their focus on core businesses and divesting non-core assets shows a commitment to operational efficiency. All right. Next, Alibaba's cloud AI products are expanding, boosting revenue. Well, they grew by 26%. If they can keep that growth up, that would be amazing. The company is returning value to shareholders with increased dividends and share buybacks. Now, as an investor, what are you looking for in a business? In a business, you want to see the ability to generate cash and to transfer that cash from the business into your pocket. And there are a few ways they can do that. If they have free cash flow, they can invest that back into the business. They can pay out dividends. They can buy back their own shares. They can pay off debt, or they can make acquisitions. These are all ways that the stock of the company can grow. Dividends, I think, is quite a well-known concept. And dividends give you money straight away. If a company has a lot of cash, you want to see them return the cash to your pocket, and you can reinvest the dividends yourself. However, if the business has opportunities to reinvest the cash at a higher rate of return than you yourself would gain by investing on the stock market, why would you want to have that cash? It doesn't make sense. It's very illogical. You want the business to reinvest that cash at a higher rate of return. And Alibaba has a 26% growth on their AI cloud services, which is extremely high. I myself aim at 15% rate of return on my investments, and Alibaba has a 26% return. So I'm happy for them to keep their cash, reinvest it in the business, and generate way above my target returns. If they do share buybacks, I'm okay with that as well. I think the stock has been quite cheap lately. It's a great time to do buybacks. If the stock is very expensive, you would not want to see them do that. The share buybacks is a way for a business to limit the amount of people you share the pie with. If you become a shareholder, you buy a piece of the pie, and the piece of the pie represents a share, or a share represents a piece of the pie. Now, if the business buybacks more shares, they take away pieces of the total pie. So you own percentage-wise way more of that same pie, and therefore, without them having to grow their business at all, your investment has become worth a lot more. And especially as the company is sitting on a lot of cash, they don't know where to invest in. Share buybacks are a great way to do that if the company is priced attractively, because you don't want to buy stock at too high a price. Price matters, and this logic is true for the business as well. They don't want to buy at a very high price. So if you see share buybacks, make sure to buy back at low stock prices. This is something that everybody is worried about for Alibaba and all Chinese investments. And whether that worry is grounded or not is, in my opinion, too early to tell. I think it generates a lot of volatility. And the way I look at it, volatility is there for you to take advantage of. And volatility as an investor is where you get paid, but it involves risk. And you have to be sure that you can manage the risk. And Alibaba has been down 50% at some point since I bought it. So I saw my stocks plummet. But I believed in the business. I knew what I was investing in. I had my own thesis, my own story. And therefore I could buy more. And currently we are on the way up. And we'll see where it goes. I'm very happy to own Alibaba, and we have invested in a great business. We can see the revenue growth. Free cash flow growth was negative. Why? Because all the free cash flow they created, they reinvested into the business, but they invested at good rate of return, and that's what you want to see. Their return on invested capital over the last few years has been a little lower. You will ideally want to see this in the double digits, in the high double digits, or above 20%, but then you have a great business. Right now they're a little downbeaten, but on the way back up, and they still have quite a lot of cash. Their cash to debt, you want to have it above 1. That means they have more cash than they have debt, and they have a lot of cash on hand, and therefore they're well positioned and well set up to invest in their own business for the future. And you can see they're buying back quite a bit of shares. There's some positives, there's some negatives. Their revenue rose subpar. Their investment in their AI related revenue was created a lot of returns, but they will keep investing, and therefore they will eat up some of their own cash and their own free cash flows. And we will yet have to see whether or not this pays off. Next up, I think we have to talk about Trump. Trump is always up to something crazy, and what did he do this week? Trump has been in a long fight with the Fed, and the Fed's mission is to limit inflation, and Trump's mission is to have a good story to tell, to have a win, and he wants the whole economy of the US to grow, and therefore inflation, a little counterintuitively, is in his advantage, because a way for the total wealth of the American people and their GDP to grow is by inflation rising. Therefore, everything they earn just increases rather than having to produce anything extra. The dollar value of it increases, but their actual production doesn't. And the Fed, they don't want to lower interest rates. Now, for Trump, this is a burden. He has quite a lot of debt, and the debt will be quite expensive. If they lower the interest rate, at least the short-term debt will be lower. And coming from a Fed perspective, their role is to limit inflation. And now Trump has announced a lot of tariffs, and tariffs drive up prices, or they could drive up prices. It's yet uncertain whether or not the Walmart and all the big retailers in the US will transfer the tariffs they have to pay to their customers. But to me, it seems very unlikely for them not to do it. But if I was a business owner, I would not want to take the hit. I would pawn it off to somewhere else. And therefore, I think it's very correct of them to wait a bit and see what happens before they lower interest rates. Everybody is expecting them to lower interest rates, but we'll yet have to see if that happens. And Trump is trying to exert more control on the Fed, see if he can get anyone fired and can appoint new people that are in his favor. Currently, that does not it hasn't happened yet, but he's trying and trying and trying through multiple angles. So we'll keep an eye out. Probably next week there's more Trump news. Now, something else that we can talk about: terrorists. That's all the buzz nowadays. Americans spend a lot more on cars, but not much else. It's kind of a non-headline, but it basically says the economy, it's yet uncertain where prices will go and what's happening in the US economy. There's nothing more than that. The tariffs are yet to take effect, and we're yet uncertain what will happen. I think right now the stock market, whenever Trump announces a tariff, barely reacts, if at all. Rightfully so, because Trump next day can figure out something else. But something unexpected could yet happen. There is still risk in the whole tariff thing going around. He can decide that tariffs are suddenly become a lot higher on a certain product. It could be cars, it could be steel, it could be medication, and it could have a big impact on you as a stockholder. So I would not be too, I wouldn't be too not cautious or too free to entirely dismiss the whole tariff risk. There's still some actual risk there, and Trump can do some serious damage if you don't look out for it. That's most of the news that happened last week. Next up, I want to look at what's going to go on the coming week. Not much. I think most of the earnings season has already happened. NVIDIA was kind of the big closer, great results, but there will be some other reports that could be interesting. They're mostly macroeconomic. So whoever is interested in that, we can discuss them next week. There will be some construction spending, some manufacturing reports, some job openings and labor turnover surveys. Very interesting stuff, or well, not at all. Federal Reserve beige book. This is all the central banks talking about their outlook on the economy. It's not very factual, but they look at it from a practical perspective. The employment survey, in initial unemployment insurance claims. Yeah, this is a big one. Employment situation report. You shouldn't take these too literally or give them too much value, but they give you an indication of what is happening. They give you an indication of what is happening in the US economy. And then there are a few other corporate earnings that could be interesting to look at. NEO, I think this is a popular stock amongst retail investors. It doesn't concern me too much. Zscaler, Macy's, Salesforce, Lululemon. I think this one could be interesting to look at. From a value investing perspective, I've heard quite a lot about it, but I've never looked at it in depth, so we could do that tonight. And Broadcom, yeah, that's about it.